Okay, so we're good to go, and we are going to start on topic number 4, which is our concept of related groups, associated groups, and affiliated groups. If we have time, we're going to start on Deck 5, which I emailed you this morning, which is the taxation of CCPC investment income, which is pretty important and ties back into our discussion of corporate tax rates from last week and the week before. So if we start on slide 2 of our deck, we have a discussion here about the ideas or the policy ideas behind our various concepts that we're going to talk about today. And so the point that we want to start with here is that there's a lot of times in income tax world where it's important to identify people whose economic interests are more or less aligned. And this is because we either want to permit them to do things without having tax apply, or because we don't want them to have undue access to tax expenditure benefits. So for an example, where control of a corporation is acquired, one of the normal results is a deemed year-end on an acquisition of control under subsection 249(4). And there's also a loss restriction event as defined in subsection 251.22. And as a result of having a loss restriction event, you have various restrictions on the deductibility of losses, which I guess was sort of implied in the name, as well as on the use of other tax attributes under subsections 111(4) and 5, and under various other provisions. So we don't want these things to happen every time that control of a corporation passes between members of a related group. So for example, if we had a parent corporation changed which of its subsidiaries controlled other subsidiaries. And so as a result, we need some kind of means of delineating who is in or not in the corporate group based on some concept of ultimate ownership. We want this concept to be, reasonably tight, but not overly tight, in order to make sure that we're not having people who are within the group be treated as being arm's length persons and causing an acquisition of control. But similarly, we don't want to be too broad so that random third parties could acquire tax attributes without having a loss restriction event. And so this is where the concept of related comes into play, and we're going to talk about that first. And as an example, that's timely given what we've just talked about. Related persons and transactions between related persons do not cause acquisitions of control or loss restriction events. As another example, we don't want a person who is related, between two related persons, or even just a single person, to be able to multiply the small business deduction, reallocate assets to avoid a subsection 125.5.1 business limit reduction, or to claim excessive refundable SR&ED tax credits by simply creating more corporations and maybe varying the shareholdings between those new corporations, ever so slightly. So as a result, we need some means of identifying which corporations are ultimately owned by the same person or group of persons, regardless of what creative shareholdings they might invent. And since we're trying to save on tax expenditures, we want this concept to be broader than our concept of a related person or a related group. And so this is where the idea of associated corporations and associated groups comes into play. And we'll talk about that after we're done with relatedness. And then finally, there are some people whose economic interests are just simply indistinguishable from one another's, or can be presumed to be indistinguishable from one or less from one another. And so in these instances, we actually don't care very much who owns an asset for tax purposes, because it's economically the same thing as the other person owning the asset. So this is where the concept of affiliated and affiliated groups comes into play. And it's relevant for things like suspended losses or superficial losses. So to the extent that we're going to talk about affiliated in this course, it's usually going to come up in the context of suspended losses or superficial losses. And we're going to talk about what affiliated means and how that concept works last, after we've talked about relatedness and association. So if we flip to slide 3 of deck 4, we're going to talk about relatedness first. As I mentioned, you would have seen the related person rules a little bit in baby tax. So I don't know that we need to, go super deep, because some of this should be a review for you. These are the easiest rules to apply, and they're the ones where you would have the best sense of how they really work just by reading the act, which is always a good starting point. We're not going to talk about how individuals are related to one another again, because presumably you did do that in baby tax, although somebody please do jump into the chat and tell me if you didn't. But again, assuming that you did, we shouldn't need to talk about that at all. We do have diagrams in the handouts that explain how the other relatedness options for corporations and others work. So as we're going through this, you may find a diagram in there that will help you out. So the first rule for relationships is that a corporation, backing up. The first rule for relatedness with corporations is paragraph 251(5)(b). And this rule can cause corporations to be related to other corporations, to individuals, to trusts, et cetera, et cetera. So basically the whole gamut of persons to be related to a corporation. And there's basically 3 rules that are found in paragraph 251(5)(b). The first, in subparagraph 251(2)(b)(1), provides that a corporation is related to the person who controls it. So, pretty straightforward. If you control a corporation, you're related to the corporation is related to you. So that one kind of makes logical sense. The second rule is subparagraph 251(2)(b)(2), and that rule provides that a corporation is related to every member of a related group that controls a corporation. So if you have related group husband-wife, and related group husband-wife controls a corporation, then corporation is related to both husband and wife, since they're both members of a related group who control the corporation. So again, that logically makes a lot of sense. And then finally, the third rule in paragraph 251(2)(b) is subparagraph 251(2)(b)(3). And this provides that a corporation is related to any person who is related to a person described in subparagraph 1 or 2. So if you're related to a person who controls a corporation, or if you're related to a member of a related group that controls a corporation, then you're related to the corporation. So for example, again, back to our second example, if related group husband-wife controls the corporation, then husband's brother, who is related to husband, is related to the corporation as well under subparagraph 251(2)(b)(3). So those are the very basic rules for relatedness with corporations. And so this is probably actually a good time to talk about the concept of a group, which I think we may have touched on a little bit before, but we do now need to focus on a little bit more. So we have a very useless definition of group in subsection 251(4). And that subsection basically defines a related group as a group of persons, every member of which is related to all the others, which, okay, cool. And then an unrelated group is defined as being any group of persons other than a related group, which again, fine. The problem here is that the term group is not itself defined, right? So how you assign meaning to the phrase group just becomes a question for the case law. And what the case law does eventually come down on the side of is that in order to have a group of 2 or more persons, it's not enough that they have some mathematical aggregation, like, I own shares of a corporation, and let's say Lisa Wang owns shares of a corporation, and therefore, Mike Dolson and Lisa Wang are a group of persons. That's not how that works. Instead, you have to go looking for a sufficient common connection between the persons, right? So if, like I said, if Mike Dolson and Lisa Wang are both shareholders of a corporation, then that's not necessarily enough for us to be a group of persons. But if Mike Dolson and Lisa Wang are, are best friends who've done business together for the last 40 years and are all, both shareholders in everything that we invest in, and we hang out all the time, and our families get together for barbecues, and we do all kinds of, crazy non-arm's length business, then that would be a group of persons. Right, so it's a facts and circumstances test. There's actually a recent case from 2020 called Reassurance Pro Mutuelle, which deals with this group concept head on. In that case, the issue was whether an amalgamation of two insurance or reinsurance companies would result in a loss restriction event when both corporations had effectively the same 27 shareholders who took the position that they were a group of persons. And so the court goes through the law and the kind of facts that you would look at to determine whether there's a group of persons. In that case, notwithstanding that there's 27 shareholders, there actually was a group of persons that existed there because the corporations were all creatures of statute and basically carried on business under the same brand, using the same IT, using the same, same back office like actuaries and all that kind of stuff. So it was really just a single business carried on by 27 people, all of which were effectively creatures of the same statute. So, that's a very good case to look at if you want to see the most recent and in-depth discussion of what is or is not a group of persons for this purpose. So that's groups. Then we can move on to paragraph 251(2)(c), which is just a list of ways that two or more corporations can be related to one another. And these do get, in some cases, to be a little bit more difficult to just think your way through than others are. I'll provide some examples as we go through, just because I by this point, having done this course for, this has got to be run through number 7 on this course, I have a pretty good idea of which ones are going to trip people up by this point. So starting with subparagraph 251(2)(c)(1), this is simple. It provides that two corporations are related if they are controlled by the same person or group of persons. So, that, again, makes really obvious sense, right? If I control my professional corporation and I control a holding corporation, the two corporations are related because they're both controlled by me, right? Makes sense. Then subparagraph 251(2)(c)(2) provides that two corporations are related if they're both controlled by a single person and the single person who controls that corporation is related to the single person who controls the other corporation. So again, to use an example, if I control my professional corporation and my wife owns the shares of a holding corporation, then those two corporations are related because they're both controlled by a single person and the two single persons are related to one another. So again, pretty straightforward. Then we drop to subparagraph 251(2)(c)(3). And this provides that two corporations are related if they are controlled by, if one corporation is controlled by one person and the other corporation is controlled by a group of persons that is a related group, and the individual who controls the first corporation is related to at least one member of that related group. So to use an example there, I see a hand. I'll jump on that in 1 second. Let's suppose in this example that we have a corporation that is controlled by an individual. Let's call him Doug. And let's suppose that the other corporation is controlled by the related group of Doug's brother and Doug's, well, I can't use that example, Doug's brother and Doug's wife. So let's say they're related to one another by marriage because they're both related to Doug, and so therefore we have an example where one corporation is controlled by an individual, and that individual is related in this case to both members of the related group who control the other corporation, and therefore are that's a good relationship under subparagraph 251 2C3. Pam, I see you've got your hand up. Go ahead.
I just think that everybody is not able to chat. It's like the chat is off or we're all blocked or something.
Weird. Let's see what's going on with chat. Yeah, it seems to be working. So David and Michael can chat at the very least. So I don't know why there'd be special rules for some of you and not others.
Do you have some of us muted by any chance?
I had one of you muted, not from chat. I had one of you actually had to mute your mic because somebody had a live microphone that I muted, but no one is muted in the chat window. Okay, let's hope that problem sorts itself out because I don't have a good fix for that problem. The other thing we can talk about just as an example with subparagraph 251 2C3, just going the other way and thinking about an example where you might be related to one member of a related group and not the other. Suppose that instead of suppose corporation is controlled by Doug's son, and then other corporation is controlled by Doug and Doug's brother. Doug and Doug's brother are a related group. They're related to one another by virtue of being siblings. But Doug's son is not related to Doug's brother because, as you'll recall from baby tax, that you're not related to your nieces, nephews, uncles, aunts. So therefore, in that example, Doug's son is related only to one member of the related group that controls the other corporation, which is Doug. But that's enough for the two corporations to be related under subparagraph 251 2C3. So then if we flip to slide 4, we can then go into subparagraph 251 2C4. And this provides that two corporations are related if one corporation is controlled by a single person and the other and that single person is related to every member of the unrelated group that controls the other corporation. So let's reverse our example, and now let's suppose that Doug again controls our corporation. And let's suppose Doug's brother and Doug's son control the other corporation. So again, Doug's brother and Doug's son are not related to one another because they're uncle and nephew, as opposed to being related by blood, and therefore they're an unrelated group. However, Doug is related to both of them, and therefore he's related to every member of that unrelated group, and therefore the corporations are controlled are related under subparagraph 251 2C4. So that's an example of how that can work there. Then we have subparagraph 251 2C5, and that causes two corporations to be related if one corporation is controlled by a related group and any member of that related group is related to every member of the unrelated group that controls the other. So again, to use the same example, let's suppose that corporation 1 is controlled by related group Doug and Doug's wife. And then suppose that corporation 2 is controlled by unrelated group Doug's brother, Doug's son. So in this case, because either Doug or Doug's wife is related to both Doug's brother, Doug's son, then in that example, the corporations are related under subparagraph 251(2)(c)(5). And then finally, we have subparagraph 251(2)(c)(6), and this provides that two corporations are related if they're both controlled by unrelated groups, and every member of one related group is related to at least one member of the other unrelated group. So this is something that, this is the one where I think I get the most questions about how this could work in theory every year. And so again, to provide an example, this is one that doesn't usually come up in the real world unless you're really looking for it. So to use an example, let's suppose that wife 1 and wife 2 control one corporation, and husband 1 and husband 2 control the other corporation. And let's suppose that there's no relationship between husband 1 and wife 2, or wife 1 and husband 2, completely unrelated persons. Let's say they're just, wife 1 and wife 2 are business associates, let's suppose. And so in this example, we have two unrelated groups because there's no relationship between wife 1 and wife 2, or between husband 1 and husband 2, or those other ones I mentioned. And so everyone is in an unrelated group, but wife 1 is related to husband 1 by marriage, and wife 2 is related to husband 2 again by marriage. So every member of one of the unrelated groups is also related to at least one member of the other unrelated group. And so as a result, the two corporations are related under subparagraph 251(2)(c)(6). So again, that one is not the most common form of relatedness that you're going to see, but it does happen where you have these, people are trying to create economically identical corporations just with different shareholders. So I think there's now we can close the loop a little bit on relatedness, and we can point out that if two corporations are controlled by related groups and all the members of the related groups are related to each other, then they're going to end up being, the two corporations are going to be related under subparagraph 251(2)(b)(3). And so as a result, that's why we don't have a similar rule in paragraph 251(2)(c) that would cause corporations that are controlled by related groups to be related to one another, because we just don't need that rule. So beyond that, we have a couple of important supporting rules for relatedness. The first is subsection 251(3). And what subsection 251(3) provides is that if two corporations would otherwise be unrelated to one another, but are related to a third corporation, for whatever reason, then the two corporations are deemed to be related to one another. So this is one, we actually might have an example of this later, so we don't need to have one right now, but this is a rule to be a little bit cautious of, because there are a lot of provisions where relatedness is important, where subsection 251(3) actually gets turned off, to the point that I think it's actually somewhat dangerous to rely on it. You need to be very cautious if you're thinking that corporations are going to be related because of 251(3), simply because a lot of stuff just outs the rule entirely. The second rule that is important is paragraph 251(5)(b), which we talked about last week or the week before, and that provides that all options or contingent rights are deemed exercised for the purpose of determining if two or more persons are related. Again, some caution is warranted with paragraph 251(5)(b), again, because various provisions provide that in determining if people are related, the act is to be read without reference to paragraph 251(5)(b), and therefore the options or rights don't count. And as well, if you're trying to avoid an acquisition of control using paragraph 251(5)(b) rights, you do have to be wary that there is a supporting rule in subsection 256(8) that essentially provides that if a right or option, etc., exists for the sole purpose of avoiding an acquisition of control or loss restriction event, then that right is deemed to be, not deemed just not to exist. Or similarly, if the right, exists for certain purposes, it could be deemed to be exercised. So, important supporting rule there as well to keep in mind. So that's relatedness. Do we have any questions about relatedness before we move on? Jacob.
I was just wondering, for the husband and wife ones, does the legislation say anything about, like, after a divorce, are they just still deemed related, or kind of how that structure would work out?
Yeah, so the act doesn't. Or your normal family law rules apply. So as you, I think, may remember from your family law course under the Divorce Act, or if you never took family law, I guess I'm telling you right now, that under Divorce Act, a husband and wife remain, or I guess obviously it applies equally to same-sex couples, so two husbands, two wives, etc., remain married until the 30th day following the entry of the order granting the divorce. And so that rule works for income tax purposes as well. That, generally speaking, even if you're separated, you're living separate and apart because of a marital breakdown, and you've initiated divorce proceedings, etc., up until that 30th day following the entry of the judgment granting the divorce, you are married, and therefore you are related for tax purposes up until that point.
Thanks.
So yeah, no problem. So that's the rule. There are certain circumstances where living separate and apart can turn off certain rules that could apply, involving relatedness. For example, spousal attribution can get turned off if you're living separate and apart. In Section 160 can in some cases get turned off if you have a transfer of property under a matrimonial agreement. But yeah, generally it's exactly what you would think under normal law. Shinjun Gong, I saw you had a hand up as well.
Oh no, I don't have a question.
Okay, cool. Okay, anybody else? Okay, seeing none, we can move on to slide 5, which is the start of our discussion of association. And so this one, we're going to go more into problems on association, but we're going to highlight the supporting rules before that. So what you're going to see is that this is actually a much looser standard than relatedness, especially because of the supporting rules that can cause people to become associated. And in fact, we're going to see it's possible for unrelated corporations to be associated corporations. So do keep that in mind. One of the reasons for this looseness, as you'll see on the slide, is that association turns on our de facto control standard, which is controlled directly or indirectly in any manner whatever, in subsection 256(5.1. And we talked about that in the context of CCPC status 2 weeks ago. In contrast, if you've had a look at subsection 251(2), you'll see that the relatedness rules all use the word control, which again is a reference to de jure control, which for all intents and purposes means voting control. So that's a pretty significant difference right from the jump. So as I mentioned, there are a ton of supporting rules that we can get into. If we want, actually, before we do that, I think let's just pull out our acts for one moment. And let us all flip to subsection 251.6, which we are going to do. Let's do that. Sorry, 256 sub 1. I may have just misspoken there. So if we go to subsection 256.1, these are the basic rules for determining if corporations are associated or not. We might as well go through them. We'll tease them out with problems some more, but we'll go through them as well, just because let's be safe rather than sorry later. So our first basic rule is paragraph 256.1a, which again, really straightforward. Corporations are associated if one corporation controlled directly or indirectly in any manner, whatever, to the other. So parent sub associated, right? Really easy. Second, paragraph 256.1b, two corporations are associated if they are controlled directly, indirectly in any manner, whatever, by the same person or group of persons. So, if I control my professional corporation and I control a holding corporation, they're associated, right? Cool. Again, very easy, very obvious rule. Third, paragraph 256.1c provides that each corporation is controlled directly or indirectly in any manner, whatever, by a single person, and the other corporation is controlled by a single person. Okay, and one person controls, one person owns in respect of the other corporation at least 25% of the shares of the other corporation. So, for example, if I control a corporation and my sister controls a corporation, and I own at least 25% of the shares of any class in the capital of my sister's corporation, then the corporations are associated. So this is a little bit different than relatedness. I think as you will obviously just infer from that cross ownership requirement, that unlike being related, these corporations clearly would be related, right? Under subparagraph 251 2C2, they would be related because they're both controlled by a single person who's related to the other. But here, to be associated, they not only have to meet that standard, but there also has to be this cross-share ownership. And again, the rationale here goes back to, for example, to our small business deduction conversation last week, that if the corporations were associated, they might have to share a single small business deduction. And like to use the real life example, my sister lives in, Wellington County, Ontario. She is not a lawyer. There's no commonality of business, even if the corporations are related. So there's no reason why she wouldn't be entitled to a small business deduction simply because I also control a corporation and then claiming a small business deduction, right? Like that's a little bit. So it's a little bit of like visiting the sins of the father on the child, right? Although in this case it's siblings. So we're not going to do that. So there has to be some cross ownership here for the corporations to be associated. Next, if we go to paragraph 256.1d, we have our next supporting rule, which is one of the corporations was controlled by a person, again, directly, indirectly, whatever, and that person is related to each member of a group of persons who so control the other, and that person owned not less than 25% of the shares of any class other than the specified class of the other corporation. So again, we can illustrate this with a fairly simple example. Suppose, again, I control my professional corporation, and suppose my two sisters, there are actually two, are the two shareholders of another corporation. Again, in order for the two corporations to be associated, then I would have to own at least 25% of the shares of any class of that other corporation. So again, the corporation would be related to one another under subparagraph 251 2C3, but in order to be associated, we'd have to have that kind of cross ownership in place. And then finally, if we drop to paragraph E, each of the corporations is controlled in any manner whatever by a related group. Okay, that's good enough. And each member of one of the related groups was related to all of the members of the other related group, and one or more persons owned and one or more persons who are members of both related groups, either alone or together, owned in respect of each corporation not less than 25% of the shares of any class. Okay, so this one gets a little bit more complicated because we need to have two related groups that control the corporations, and we need to have cross ownership by a person who's related to the members of the other related group. So let's think about how we can illustrate this one. Suppose that my wife and my wife's brother are shareholders of a corporation, and suppose that suppose my wife's brother's daughter, so my wife's niece, and my wife's mother are the shareholders of the other corporation. So my wife's brother, these are both related groups, obviously, because the grandmother and the niece are related to one another by blood, because one is a lineal descendant of the other, and my wife and brother are related by blood by virtue of being siblings. And so in this case, my wife's brother is related to both his daughter and to his mother, and therefore he's related to every member of the other related group. And so in order for the two corporations to be associated, he would have to own at least 25% of the shares of the other corporation. So again, that one is a little trickier, and you're not going to encounter that one in the wild all the time, right? It does happen. Where people think they're being smart and they end up associating two corporations under paragraph E, but generally speaking, not the most common basis for association. So those are the basic rules, right? Which it doesn't sound that broad, right? We had 9 different ways that two corporations could be associated, sort of could be related, and we saw that there's that subparagraph 251 2B3 especially is so broad that it makes it actually quite easy for two corporations to be related. And it would say, well, we only actually have 5 ways that that two corporations can be associated. They're not seemingly that broad, but as we're about to see, it's actually it's the supporting rules that make association quite scary, right? Because there just are not equivalent supporting rules in determining if corporations are related. And the supporting rules are what really trip people up. And I think if you're going to practice tax, especially in Edmonton, Saskatoon, etc., somewhere where there's a lot of small business clients, knowing those supporting rules, or at least being humble enough to make sure you check the supporting rules every time, is probably going to save you some embarrassment in practice. So if we go to slide 6 of our deck, we have our first supporting rule. And what you would have seen as we just did our very quick 10-minute walkthrough on subsection 256.1 is that all of these rules carve out shares of a specified class, or not all of them, but the important ones where corporations aren't controlled by the same person or aren't controlled by one another, carve out shares of a specified class. And so, you'd say, okay, well, what is a specified class? And so you would flip to subsection 256.1.1, which is that definition. And in order for the shares to be shares of a specified class, they have to meet various conditions. In particular, I'm going to read this a little bit because it's important to get these right. The shares must be redeemable and retractable. They must be non-voting shares. They must have no rights under the corporation's articles of incorporation, unanimous shareholder agreement, etc., to convert the share into anything else that is not a specified class share. The dividend on the share has to be calculated as a percentage of the redemption amount, and the dividend rate cannot exceed the prescribed rate of interest at the time the share is issued. And finally, the redemption amount cannot exceed the value of the consideration given for the share. So this last one is important, that you actually have to issue specified class shares for consideration. And I can tell you that I have seen in real life people get blown up on that one, that people have tried to issue specified class shares as payment of a stock dividend, and it ends poorly for them because of that last rule. The share has to be issued for consideration. It can be issued for money, it can be issued in exchange for other shares, but it has to be issued in exchange for some kind of consideration. And being issued as a dividend is not consideration, right? Because you not give consideration for a dividend as a matter of law. So that is a serious problem for people with specified class shares. The other stuff, basically it's your redeemable, retractable preferred share, right? Like it's a debt-like preferred share. For IFRS purposes, you actually would have to put it on the financial statements as a debt instrument. I understand. I think there's some talk about PE GAAP requiring that as well now, or ASPA, which everybody I know who's an accountant has a giant freak out about that every time that discussion rears its head. And then the other important point is just the prescribed rate of interest point. So that's regulation 4301. The prescribed rate of interest, basically it's the effectively the 90-day Bank of Canada T-bill rate rounded to the nearest percentage, and rounded up to the nearest percentage. So right now the prescribed rate is 1%, which you would say theoretically is as low as it can go, but then if you recall that many countries actually have negative interest rates on 90-day T-bills now, theoretically the lowest possible rate is actually 0. Well, I guess it could be, in fact, it could be lower than 0 if the rates got below -1%, but that strikes me as highly unlikely. So you could theoretically have a 0 rate, I think, as we've discovered in 2020, 2021. But basically, in all likelihood, 1% is the lowest it can go. So that's the prescribed rate of interest right now. So if you wanted to have a specified class preferred share, and it was issued in Q1 2021, it would have to be issued with a 1% interest rate, or 1% dividend entitlement anyway. Thomas, I see you have a hand up.
Yeah, I'm afraid this is not a tax question, but still I'm a little bit confused why the dividend is not considered as consideration. Imagine I receive the dividend and take the money and then use the money to buy the share, then it will be okay. So what is the difference between the two?
Well, that is an excellent question, which you can direct to, among others, the Federal Court of Appeal rather than me. But the rationale is that, I'm going to try to state this correctly, is that a dividend is an in rem right attached to a share, as opposed to an in personam right attached to the shareholder. So the dividend is basically it's an entitlement of the shareholder, irrespective of who the shareholder is. It is not a payment. It's effectively a gratuitous payment of the corporation. It's a distribution by the corporation of its retained profits. The shareholder did not provide consideration to the corporation for the dividend. They simply provided consideration for the share, which they may not have actually provided to the corporation at all if they bought the share, for example, on an exchange or from a prior shareholder. So that's the idea. You will see this in practice in the context of Section 160, where idiots get themselves blown up on that point. Not lawyers, but just clients. So that's the idea. Why you can't do this? What you're suggesting, where you would pay a cash dividend, have the cash, have that and then use the cash to subscribe for the share and have a prescribed share, versus issue the prescribed share on a stock dividend. As we're going to see when we talk about stock dividends maybe late next week, you're going to see that cash dividend and a stock dividend are actually fundamentally different transactions for income tax purposes. Even if the corporate law treats them as broadly the same, like with the same solvency tests, et cetera, under the BCA. For tax purposes, stock dividends and cash dividends can be profoundly different transactions depending on how much stated capital you add. So it actually, for tax purposes, doesn't follow that a stock dividend versus a cash dividend and subscription are actually the same transaction.
Okay.
Yeah, I realize that was a lot of answer for what seemed like a straightforward question, but yeah, there's some stuff happening there. Anybody else? Okay, seeing nobody else and seeing that we're basically at 150, let's take 10 because I think we're going to get into some more meaty stuff in a moment, and I think we might as well take our break first. So let's take a break. Let's come back at 2 o'clock, and we'll pick back up.